Welcome everyone. Today we're going to discuss about macroeconomics concern, especially money and banking issues. What is money? Barter, literally trading one good or services for another without using money. Commodity money, an item that is used as money but which also has value for its use as something other than money. Commodity backed currencies, dollar bills or other currencies with values backed by gold or other commodity. Double connections of wants, a situation in which two people uh, each want some good or services that the other can provide. Fiat money, something used as money but which has no intrinsic value beside that. Medium of exchange, whatever is widely accepted as a method of payment. Definitions, defining money by its function. Money solves the double coincidence of one problem. First, since money is generally accepted as a means of payment, of medium of exchange. Second, people are willing to sell something for money. Third, money serves as a unit of account. Money is anything that can serve of all of these functions. It is a measure of wealth, a store of value, a unit of accounts, and a standard of deferred payment. Commodity versus fiat money. Money has taken a wide variety of forms in a different cultures. Example of commodity money is gold, silver, ware shells, cigarette, and even coca beans. Fiat money has no intrinsic value, but is declared by a government to be the large tender of a country. Measurement money, coins and currencies in circulation. The coins and bills that circulate in an economy that are not held by the US Treasury, at the Federal Reserve Bank or in a bank vault. Credit card. Immediately transfer money from the credit cards company checking account to the seller. And at the end of the month, the user owns the money to the credit card company. Credit card is a short-term loan. Debit card, like a check, is a instructions to the user bank to transfer money directly and immediately from your bank account to the seller. Demand deposit, checkable deposit in the bank that is available by making a cash with a withdraw or writing a check. Liquidity, how quickly and easily an asset can be converted to a means of payment to make a purchase. M1, money supply, the narrow definitions of the money supply that includes currency and checking account in bank, and to a lesser degree traveler checks. M2, money supply, a definitions of the money supply that includes everything in M1 but also adds some deposit money market funds and certificates of deposit. Money market fund, it's deposit of money investors and pour together and invest in a safe way, like short term government bonds. Saving deposit, bank account where you cannot withdraw money with writing a check but can withdraw the money at a bank or can transfer it easily to a checking account. Smart card, star a certain value of money or a card, and then one can use the card to make purchase. Time deposit, account that the deposit has committed to living in the bank for a certain period of time in exchange for a higher rate of interest, also called certificate of deposit. M1 is a most narrow definition of the money supply, includes coin and currency in circular. M2, a broader definitions of money. M2 includes everything in M1 but also added other type of deposit, includes saving deposit, money market funds, certificate of deposit, etc. M1 supply, coins and currencies in circulation, checkable deposit, traveler checkers, saving deposit, money market funds, certificate of deposit, other time deposit. Credit, when you make a purchase using money that you do not have, you are using credit. Credit is something else money that they have lent to you. Typically you use credit to buy something like a car, a house, or a college expense, a big ticket item that will benefit you for a long time. Instead of saving up and only then paying for them, credit allow you to buy now and pay for them over time. Sometimes people obtain credit in advance so that in the future, with opportunities or needed arise, they will be able to buy something. Credit come in many form, including loan, bonds, note, or lines of credit. All are essentially loans, that is promise to reply with interest. Debit is accumulate credit less what has been replied. If you look at the credit card statement, each purchase you make using a credit card is a loan from the credit card company to you. Your total debit is the sum of the money you have borrowed from all of your credits. Bill, short-term debt instrument. Bonds, long-term debt instrument. Debt instrument, IOUs. Equities or stock. Ownership is a private company. Initial public offering. Original sale of stock by a corporation. Note, intermediary terms, debt instrument. Securities. Synonyms for financial asset. Financial market and asset content. What do individuals put their savings and what do a business they obtain the funding for investment expenditure? The answer of both of this question is financial market. Financial market includes the banking system, equity market like the New York Stock Exchange or the Nasdaq stock market, bond market, commodity market, and more. Financial market are global. American put their savings into foreign as well as domestic bank account, foreign account, and domestic stock, and the foreign and domestic bond. All financial assets are called securities. Interest rate, the price of borrowing in the financial market, a rate of return on an investment. Interportal decision making, the study of how people make choice about what and how much to do at various points in time, when choices at the time influence the possibilities available at other point in time. Financial market are make up on of a large number of market for different type of securities. Each financial asset is a substitute for every other financial asset, and thus all financial market are linked directly or indirectly. Checking account, a bank account that typically pays little or no interest, but that gives easy access to money either by writing a check or by using a debit card. Credit card, a non-profit financial institution that is members own and run. Debit card, a card that lets the person make purchase and the financial institution immediately deduct cost from the person checking account. Depository institution that accept money deposit and then uses this to make loans. Financial literacy and institutions that operate between a server with a financial asset to invest and an entity who will borrow those assets and pay a rate of return. Payment system by which buyers and seller exchange money for goods, service, and financial capitals. Saving account, a banking account that pay an interest rate, but withdrawing money typically records a tip to the bank and a automatically teller machine. Transaction cost, the cost associated with finding a lender or a borrower for money. So here is the source of money: banks, withdraw, savers, deposit, loan, borrower, replace on loan. Bank play the two key roles in the functions of the economy. First, by facilitate the payment system, and the second by serving at financial intermediary. Bank make it far easier for a complex economy to carry. So banking asset and liabilities. Asset, item of value that a firm or an individual own. Asset liability time meshes. Customer can withdraw a bank liability in the short term while customer repay its asset in the long run. Balance sheet and accounting tools that list assets and liabilities. Bank capital, a bank net worth. Diversify, making loans and investment with a variety of form to reduce the risk of being advertised effectively by event at one or in a new firm. Liability, any amount of debt that the firm or an individual own. Net worth, the excess of the asset value other and above the amount of liability total asset minus total liability. Reserve, fund that a bank keep on hand and that does not loan out or invest in bond. Banking asset and liability, T account, a balance sheet with a two common format with the T-sharp form by the vertical line drawn by the middle and horizontal line under the column heading by asset and liability. Treasury security, government debt obligations in which government sells short-term bills, intermediary term notes, and the long-term bonds to raise money. The T is a T account separate the asset of a firm on the left from its liability on the right. All firm can T account thought most are much more complex. How bank create money? Bank create money through making loans. Money multiplier, ratio of total money in the economic dividend by the amount of reserve, or the ratio of exchange in the total money in the economy divided by a change in the amount of reserve. Formula: money multipliers. Reserve require reserve ratio, percentage of total deposit a bank must hold as reserve. So if we go for the quick review, we find what are the function of money: contract, commodity money, and the fiat money. Contract and classify money as a either M money supply or M2 supply. What is credit? What are the financial market and their asset and including securities? What are the type of financial market and the how they are linked? What are market forces determined by interest rate in financial market? How do bank act as an intermediary, borrower, server, and borrowers? What is the difference between bank and credit union? What is a bank asset and liability in an account? Analyze the cause of bankruptcy and recessions. How do bank create money? How do calculate how bank create money using the money multiply formula? These are the different kind of issues we are discussing in an effective way, and this is the objective, that how we can create some money and how we can manage this system. If we can analyze these things in an effective way in terms of macro initiative, that time we move in an effective way, and we can grow in an effective way, and we can make economy in an effective way. So thank you everyone, those who join with us. If you have any kind of questions, you can ask me questions. Thank you.